decide on the surname. We're very wise in picking up this one. It means the head of a lion. He is quite an important thinker with very important ideas and concepts. I remember that when his first book was published, and a book that made him a very famous man, a book on Keynes, an important Keynesian scholar told us that this book was very important, that we all should read it. Well, usually, in 2 months, you never know of a book being published in another continent, but this is, again, not a coincidence. Axel followed his thread of research, and most importantly, he followed an important school of thought, focusing on people that are never very importantly studied, i.e. Wiesel and Keynes. And this enabled him to below some skepticism vis-a-vis the new turns of economic theories. And by the way, he devoted attention to many other subjects. For those of you who are interested in learning more, there's a nice book edited by Elisabetta De Antoni containing some of his most important essays, as well as a very thorough and exhaustive biography. Axel has been a very independent thinker, and before going to the US, he was a sailor as a young rebel. And I believe that this has had important repercussions on his future life as an independent scholar again. He recently financed an important project to try and put together original thinkers, innovative thinkers who could have a say on what is actually happening before our eyes. And he's been one of those scholars. Now, we are all here to listen to his lecture, and I'm sure we are about to listen to a very interesting lecture. So over to you.
Kind introduction, and let me start by just saying that it's a great pleasure to be back in Trento again. This is the 15th year that I come here for some months, and Trento has become a second home to myself and my wife, and we always have great joy in coming back to this community and the surrounding beautiful landscape. Today's topic, the financial crisis and the deep recession that's resulted from it, have revealed serious inadequacies in financial regulations in various countries, serious inadequacies in monetary policy doctrines, and also in the economic and financial theories on which regulations and the policies have been based. So the problem I want to discuss come under three headings. Informazione, which is supposed to be the theme of the festival. Instabilità, instability, and incentives. So I will take these three parts in succession. Now, the United States mortgage markets has produced losses around the world of hundreds of billions of dollars to financial institutions and investors. Now, much of this has been blamed on the lack of transparency of the new markets for securitized mortgages. Now, lack of transparency is a fancy way of saying that investors did not know what they were buying and selling, so that as a consequence, the markets for these instruments did not know how appropriately to price the assets that were being traded. Now, the new practice of securitizing loans was instrumental in bringing this situation about. Before these recent developments, banks used to make the loans and hold them on their own books until they were paid off. So that was originate and hold. Today, the originator of a loan, which may be a bank or a broker, sells the loan to a financial institution, which bundles it together with a few hundred other loans and then sells as securities that are claims on the income streams from this bundle. The buyers of these collateralized debt obligations, as they are called, or CDOs for short, were then ended up being the actual lenders. But these actual lenders knew practically nothing about the borrowers who were liable for the loans. Sometimes the ultimate lender would be even further removed from the borrowers, because we had another practice where several of these CDOs were bundled together as the basis for another security that we claim on this bundle of bundled loans. So a whole hierarchy of loans where the higher level were several steps removed from the borrower. So then the question is, why were people willing to invest in these products where they had basically no information about the creditworthiness of the ultimate borrower? Well, everybody in the market certainly knew that these were risky instruments, but they lacked also the information to evaluate the risks. And there were two basic reasons why the markets were able to operate despite this lack of information. First, many relied on the evaluation of the rating agencies. You know the names of them: Moody's, Standard & Poor, and Fitch. The agencies issued ratings on CDOs based on the finance theory that these securities pooled risks and that these risks were not all highly correlated. A mortgage CDO, therefore, would be less risky than the individual mortgages that it was based on. That theory, in the crash, proved faulty. When the crash came, defaults turned out to be very highly correlated, and the losses on the CDOs then much higher than anybody had anticipated. Secondly, many investors, many institutions, thought they could unload the risk of these instruments to other third parties through credit derivative swaps. That a credit derivative swap is a form of contract that carries insurance against default. So this meant shifting the risk to third parties who also knew absolutely nothing about the creditworthiness of the underlying loans. Now, the development of these credit derivatives were widely believed to disperse risk throughout the economy so as to make the system as a whole actually safer. But two things went wrong from this point of view. First, because the individual institutions thought they had less risk, the system as a whole took on more risk. The economy as a whole took on more risk. And secondly, not all the risks were widely dispersed. Some very large concentrations of default risk developed that turned out to pose a systemic danger to the entire economy. Most widely known of these concentrations of risks were the American insurance company AIG that proved to have very large holdings of one-sided credit derivatives. Had this insurance company been allowed to fail, not only would people have lost their life insurance and so on, which was a larger part of their business, but the counterparties to the credit default swaps, that is the other banks to which AIG had sold insurance against the default of various entities. And those counterparties included virtually all the big banks in the United States, in Britain, and many in Europe. These counterparties would all have been in imminent danger of failing. So the American government found that it was forced to bail out AIG to the tune of 180 billion, miliardi to you, 180 miliardi di dollari of taxpayer money. There was also a third factor that were inducing people to invest in these products that they know so very little about, namely the policy of our central banks. Following the so-called dot-com crash, the internet crash in the market in the United States, the Federal Reserve System in particular pursued an extreme low interest rate policy. Now, when the central bank holds a very low, near zero interest rate, it forces down the interest rates on all relatively short and relatively safe assets in the economy. So financial institutions intent on showing good profits and who could not get their customary profits from investing in safer assets were induced to invest in riskier instruments. And they could do these investments with money obtained from the central bank at an interest rate that was virtually zero. So let me just say about the present recovery, or the present measure of recovery, that one of the big worries about the present situation is that it is based on the same central bank policy of maintaining almost zero interest rate, and that this policy is inducing the same behavior by all the major market participants as brought us into trouble in the first place. So I forgot to advance this my diapositive. Now, I want to turn to my second topic, which is the instability of the system that we have allowed to develop. You know, first maybe I should give a little bit of historical background, a very simple point. So just look back to the 19th century, the 1800s. The financial system 150 years ago was essentially a banking system. It was composed of banks. Now, what were the characteristics of these banks? The banks borrow on short term. They borrow your deposits. At that time, they borrowed by issuing notes. They lent on longer term, and they held, that's number two. And number three, they held relatively little capital in relation to their total liabilities. All right? Those three characteristics proved to make the financial system of the 19th century unstable. It produced periodic bank runs and financial crashes at great social cost. Now, it took us over 100 years to learn how to regulate this old banking system so as to make it reasonably stable. Right? Now, the financial system that has evolved over the last 30 or 40 years extends far beyond the banks that still remain, in a sense, its core. But as a whole, this modern system has the same characteristics as the banking system of the 19th century. The financial system as a whole borrows on short term, lends on longer term, and holds surprisingly little capital in relation to its liabilities, which is to say it's said to be highly leveraged. So, since it has the same fundamental characteristics as the 19th century system, it is not surprising that it has proved unstable. And its instability has resulted in truly enormous social costs. We have not learned yet how to regulate this system so as to stabilize it. As a matter of fact, we have even deregulated the banks that constitutes its core, so we have made things worse. And obviously, we cannot afford to take 100 years of trial and error to find out how to stabilize the financial system that we have now allowed to develop. Now, I want now to put the mess, the problem of the American market for subprime mortgages and so on in perspective. Because so much of the discussion in the press, in the political circles, has centered on these problems of information in those markets that I started by talking about. And what I want more than anything to emphasize in this talk is that this is a serious problem, it's a costly problem, but in relation to the problem of the instability of the system, it's a minor problem. So we have to put it in perspective. The losses in these markets are estimated, in the subprime market are estimated, these are Bank of England figures, to have been 160 billion or miliardi di dollari worldwide. That estimate is a few months old, so maybe it's a bit bigger today. We can add to that the Alt-A mortgages, which are supposed to be a little bit safer than the subprime, but where there also have been large losses, and we come to a figure of 233 miliardi, which is a nice sum of money from the standpoint of our individual households, but it's dwarfed. So this figure, let's say, the $233 billion, is supposed, in the general discussion, to have been the shock that has hit the world economic system. But now we have to see what have been its consequences. This sum of the losses on mortgages is completely dwarfed by the losses in, let's say, the national income in the last 2 years in the USA, the United Kingdom, and the Euro area. And the loss of income in the United States has been $6 trillion. That's, say, miliardi di dollari. In the United Kingdom, 670 miliardi di pound sterling. In the euro area, 4 miliardi di euro. If you add those losses of income up, you come to a sum that is 50 times larger than the supposed shock. Or you can measure the relation between the shock and the effect by the loss in asset values at the low point in the market. Of course, the market has now turned around, but we will not discuss that at this point. In the United States, the loss in asset values at the low point of the market was approximately $10 trillion, 10 miliardi di dollari. In the United Kingdom, 1 trillion pounds, and in the euro area, approximately 4 trillion euros. If you add those numbers up, again, you come up with effects of the shock that are 50 times larger than the shock itself. Actually, the last one adds up to 75 times larger. Another way of looking at it is the resources that governments had to commit in order to stop the collapse of this house of cards that we had erected. In the USA, we had an increase in the deficit of over $1 trillion. In the United Kingdom, 130 some miliardi. In the United States, the additional money creation is almost $4 trillion. In the UK, 320 miliardi, not bilioni. I don't think we have bilioni, do we? And in the euro area, close to 1 trillion. And to that you should add 5.5 trillion in guarantees by the government of private sector debts and injections of capital into the banking system and in the American system, also into the automobile industry, and so on for the UK and the euro. Now, adding these numbers together, you should realize, is adding apples and oranges. You're not, strictly speaking, supposed to do that. But you would come up with a number, again, that is 50 times as large as the shock. Right? So, this amplification of the shock demonstrates that we have a very, very unstable financial system that poses a great danger. And what is the lesson about that? The lesson is we must not focus just on solving the problems of the mortgage market or of the markets for other securitized products like student loans, auto loans, credit card debts, and so on. Those are serious problems, all right. But if we think that by solving those, we solve our main problem, we are completely in error. And it's a very, very dangerous error to make for us all. Because the unstable financial system can collapse for completely different reasons next time. What we know about it now is that it is a house of cards where a little impulse will cause a collapse that gathers tremendous momentum and that it takes enormous governmental resources to halt. And that's a general property of the system that has nothing in particular to do with subprime mortgages. Now, the variable that is central to this instability is leverage, which that is to say, the ratio of debt to own capital of a firm or a household, or for that matter, of a country. A few numbers that I don't have on the slides. In the last few decades, the ratio of liabilities to the income streams that must support them, out of which the servicing of the liabilities must come, has reached heights unknown in earlier times. For example, in the United States, if you go back to the 1970s, financial sector liabilities were less than 20% of GDP. Today, the figure is close to 120% of GDP. So it's approximately, leverage for the financial system is approximately 6 times as high. And in the United Kingdom, the same figure has multiplied by a factor of 5 approximately. This is an enormous development. Now, for the United States, let me give you some figures compiled by the Federal Reserve Bank of Kansas City, which shows that this long-time increase in leverage is not just within the financial sector, but it's actually true of all major sectors of the economy. For example, household debt averaged about 50% of personal income if you go back 40 years to the 1970s. In the year 2000, we'll have to see whether this talk comes to a natural end because my voice departs. So 50% in 1970. In the year 2000, it had reached 76%. That increased by half over 30 years. But by the end of 2007, American households had a debt that was 110% of their personal annual income. So in those last 7 years, it had grown extremely rapidly. If we go to non-financial business, we find the same tendency, although the figures are less alarming. So non-financial businesses, manufacturing, farms, and so on, had around debt of 60% in relation to GDP in the mid-70s. And that 60% had grown to approximately 90% at the end of 2007. And very significantly, of course, the federal government's debt was 30% of GDP in the 1970s, has now shot up to over 60%, and as you well know, in the current recession, it's growing very, very rapidly. So this increase in indebtedness is a quite general phenomenon, and so the financial system is more important, but it's affecting the whole US economy. So il scoiattolo, that is the symbol of the Festival de Economia, I'm afraid is not a good symbol for the economy of the United States. It just doesn't fit very well, unfortunately. Now, so it's true about the economy as a whole, but it's still the very large banks and the so-called shadow banks that are outside the proper banking system that are the heart of the problems we are experiencing now. For example, the leverage based on tangible common equity of the 10 largest banks almost doubled between 1993 and 2007. It was 18, that is, their debts were 18 times their capital in 1993. In 2007, it had reached 34. That's a very high ratio. Now, that 34 figure does not include very important liabilities that the banks had managed to put off their balance sheet. So you may know that, for example, Citicorp had 8 separate so-called SIVs, special investment vehicles, in the Cayman Islands, where they escaped United States regulators, which turned out to carry very, very large liabilities that would have brought Citi Corporation into bankruptcy if it hadn't gotten massive government help. And it included, these hidden liabilities included the 50 miliardi di dollari that Lehman Brothers managed to put under the rug with its so-called Repo 105 tactic. Now, what has been going on here? Let me try to talk about this in very simple terms. So you can, we start with this figure here. You have a bank. This is a bit high, but it makes the arithmetic easy. Suppose it has a leverage of 40. That is, its liabilities is 40 times its own capital. Why is it up so high? Because if it's able to buy assets in the market that earn it half a percentage point more than its liabilities, right? Then it can report a return on capital of 20% to its shareholders. And this is much higher than is earned anywhere in the real economy. That 20% rate of return, of course, is the basis for the high remuneration that the people in the bank are taking. So these enormous remunerations that bankers have taken are motivated by the fact that they earn a 20% rate of return and are supposedly geniuses of finance. But actually, running a high rate of return is not difficult. It doesn't take you to be a quant trained at MIT or Bocconi to do this, as long as you dare to face the risk associated with a leverage of 40 in this example. Now, we didn't start out at 40. We started out, as the figures I cited, was at 18, a leverage of 18 in 1993. And we got in a few years to a leverage of 34 average of the big banks. And some of them were quite a JP Morgan, for example, was in better shape than the others. What drove you to it? Well, I have a leverage ratio of 18. I buy an asset that earns me 0.5% more than what I pay on my liabilities. And so I report profits of, 9% or something like that. Right? So maybe the margin between the two rates of return were a bit higher. But now other banks will copy my investment strategy. So they issue the same liabilities and they issue the same, and they buy the same assets. So the markets between, the margin between what my liabilities and my assets is shrinking. But my shareholders want me to shoot for a 20% rate of return. So what do? Well, I add leverage. The first thing I do is add leverage. I just blow up my balance sheet in relation to my capital. And the second thing I do is I look around and say, these assets that I've been buying where the rate of return is coming down are not as profitable as they used to be. So let's look around for some better rate of return. Where do you find a higher rate of return? Well, you find assets that promise a higher rate of return in more risky asset classes. So the banks are moving to higher leverage and they are moving into riskier classes, and the risk premia now, because of this competition, are also shrinking. So at the end of 2007, the system has, by competition, trying to maintain a 20% rate of return. And is ending up with historically unprecedented leverage ratios, with historically unprecedented low risk premia in the markets, and, as it turns out, lots of assets that are about to turn poisonous. Right? So high leverage is very profitable as long as the going is good. And the rate of return on capital of the big banks was also about twice as high as it had been in the good old days of the 1970s. Twice as high until the crash, of course. Right? Of those banks that were allowed to fail, prominently Lehman, you have to end up with one last piece of the calculation, which is to say, oh, in the last year, you lost 100%. So high leverage means that small losses will make a bank insolvent. And the trouble with this is that the attempt to reduce leverage well, take this example. If you take that same bank, if it loses 2.5% in the assets that it's holding, and suppose 20% of its assets are in subprime mortgages, right? Then it takes a loss of 10% on those to make it insolvent. Now, when all the banks are in this position and you get these losses on one class of assets, and all the big banks know that the balance sheet of my competitors is very similar to mine, and I am technically insolvent. What does it mean? It means I must not transact with my usual counterparties any longer, because they may not be able to pay me back. So all the interbank markets freeze, and all the banks try to now reduce leverage so as to get back on safe soil again, out of the deep water onto the beach, so to speak. But when they all try to reduce leverage, it turns out the credit markets are no longer open to the real economy. There's no lending taking place. They're trying to sell assets. Asset prices are falling. And this is an unstable process because their attempts to save themselves makes the situation steadily worse. And this is the house of cards aspect of it, which necessitates unprecedented government incentives, government interventions. Okay, what do we do about this? We have to start from one basic realization. Governments around the Western world were not in very good fiscal shape when this started. All Italians know this about their own government, of course. But the crisis has essentially exhausted the ability of, say, the government of the United Kingdom to handle another crisis of the same magnitude. And I would guess that the government of the United States would not be able to handle another crisis of this magnitude either. Right? So what does that mean? Well, most immediately it means that we have to adopt policies that minimize the risk of a recurrence. Because the current crisis, if you take an American perspective, right, the current crisis has reduced the influence of the United States in the world enormously, and including its ability to wage war in Afghanistan and whatever other places we might wage the next war. That you might see as a benefit, perhaps. But the point is that the crisis has changed basically the balance of power in the world. So, to minimize the risk of a recurrence, what do we do? Well, this is first and foremost a problem in regulation. And so let me end by discussing this is where I am. I always forget to press this button here. I'm sorry. You may think of the problem of reforming regulations in these terms. There are two ways of thinking about it. One is, so to speak, to accept the incentives of bankers as they are and say, they acted so as to bring us into this situation. So they had the incentive to do it. We have to build fences around them which say you may not do this, you may not do that, you may not get a leverage ratio higher than this, and so on. And hope that that improves the system. The trouble with that is what? the trouble of that is that the financial markets have proved probably the most innovative of any of our industries in recent years. And much of the innovativeness, much of the unquestioned brain power of Wall Street, okay, has gone into finding ways to circumvent regulations. Right? So, what are the examples? I mentioned two examples. The Basel Accords were supposed to tell the banks how high a leverage ratio they could keep. How do we avoid the Basel Accords? Well, you put special investment vehicles in the Cayman Islands or some other place, and those liabilities don't count. Right? And, or you hide your liabilities like Lehman Brothers did with the repo 105 and so on. Now, okay, so we add rules against those things. But the trouble is to keep one step ahead of the innovations, not to discover years after the fact that they've come up with these methods of evasion. Right? And that is very difficult. There are many reasons why it's difficult to keep one step ahead. But the basic difficulty is that the guys that invent the new ways of getting around the regulations earn millions of dollars on Wall Street, and the people who are supposed to anticipate their evasions of the regulations earn maybe $100,000 a year in government service. And that causes what? That causes sort of a drain of the brightest brains from government service to Wall Street, and the government ends up somewhat incapacitated. So that's a basic problem. So what is the other attitude? What is the other approach to regulation? The other approach to regulation is to say, can't we change the incentives that people are acting on in the financial market? So the lack of transparency in that we talked about in the mortgage market, you can ask, why was that there? Well, because nobody had the incentive to provide the information that would make it possible for people to know what were the riskiness of the assets they were buying. What you had was a long chain of transactions from the originator of the loan and the borrower to the holder of a CDO of CDOs. And along that chain, the rule was just caveat emptor all the way, with no information provided. So what's the solution to that? Well, it's basically legal changes that imposes on everybody in that chain a requirement of due diligence in the securities that they sell. And if due diligence is found to fail, they are liable at court. Stronger than due diligence would be to impose a strictly fiduciary duty on the banks towards their clients, towards the buyer of the securities that they do. And that would cause the markets to become transparent if we moved in that direction. But I said before that that's not the main problem we are facing. The main problem is the instability of the system, and the key to the main problem is high leverage, particularly in the financial markets. So I have a suggestion that will not be popular with bankers. And it's the following. If you go back in history, in the early days of commercial banking, the owners of the banks had unlimited liability. If the bank failed, the owners were liable to the full extent of whatever they owned to cover the debts of the bank. Later, in American history at least, we had a long period in which bank shareholders had double liability. So they hold a share of the bank with a face value of $100. If the bank fails, of course they lose those $100, but they also have to put up $100 from their own wealth to satisfy the debts of the bank. That's called double liability. My suggestion is we can't impose double liability on bank shareholders today, I don't think. And the reason is, if we did that, we would find probably that we cannot raise the capital that the current financial system requires to operate in a socially appropriate way. But we could make the management of the banks bear some responsibility for their actions that they do not bear today. And how would you do that? Well, also today, higher level executives of the banks get some of their remuneration in the form of shares or share options. Right? And I would make it legally required that executives of banks are paid with shares, but a particular form of shares. Let's call them E-shares for employee shares. And that these shares would be subject to double liability. So you may have a scheme whereby employees in the banks that have nothing to do with their investment decisions are just paid in the usual way. But people who are involved in the investment decisions have to be paid partially in E-shares, and maybe the CEO of JP Morgan or Citibank should be paid 80% of his total remunerations in these shares. They would have to hold these shares until, let's say, 5 years after they leave the bank to go into retirement or to switch to some other thing. And if the bank fails during that period, as before, they lose the value of those shares, of course, because the shares are now worthless. But these people would also be liable to an equivalent amount of their other wealth, which would help pay off the creditors of the bank. And that would make at least a little buffer between bank management and the taxpayer, because the first bailout would be in terms of money coming out of these E-shares. And it would, I think, make a very strong change in the incentives of bank managers and would make them more conservative. Those of us who are of an advanced age will remember that back in the dim historical past, the cliché of a banker was that a banker was a dull and conservative and cautious person, right? Not somebody to invite to your cocktail party. Okay. Well, the bankers on Wall Street or in Milano or in London today have nothing in common with that old picture of a banker. They are high-stakes gamblers, you know, people that should be in Las Vegas and not in your bank, right? And I think that the way to try to bring about a change in the culture of banking as it is now is this double liability. It creates some other effects on banks because it may be a partial solution to the famous too big to fail problem. Why? Because if these people are under double liability, the bankers in one department of the bank will have a lively interest in what they are doing in other departments of the banks that they don't have today. And that causes the fact that, you know, the people over here say we are threatened with our double liability losses for what you are doing, will cause a lot of internal conflicts of interest within the bank. And they may find it a suitable solution to that, to spin off certain departments as separate entities, and that would help solve the too big to fail problem. And with that, I have not solved all the problems of the world, and I'm not able to do so in the 3 minutes left to me, for which I apologize. But I think it would be best if I quit at this point. Everything goes dark, I go blank, and you can perhaps pose some questions or comments.
Bene, voglio ringraziare.
I'd like to thank Axel for this very interesting lecture. As you probably noticed, Alex has been focusing on something which is not normally focused upon, that is the weakness of the economic system, and that something different from what has just happened may happen with the same consequences as we've seen now. Alex has explained how we got to this situation, and he's come about with a possible solution. So he certainly touched upon different subjects, so that I believe that there are quite a number of questions from the floor. There's time available, so please do ask questions into the mic. Mic is not on.
The profitability of the U.S. industrial sector belonging to the 500 Standard & Poor companies declined dramatically from, let's say, 8% to let's say, 1.8%. So all the capital tried to direct itself to the financial sector. In 2008, I'm not very sure of this date, the financial sector in the United States gained 40% of the profits, employing 5% of the people, whilst the industrial sector, with 95% of the labor force, gained 60% of the profit. My conclusion is that because of this so low profitability of the industrial sector in the United States, will push the investment sector, in particular investment bank, to continue the activity of gaining high profits from their activity. And this is what which is being the reality of the moment, because the investment banks return the capital had from the state to the state itself in order to freely continue to gain profit from their activity, gambling activity. Are you on this line, or I wait for your answer?
Well, I think I agree with the fact that too much resources have flown into the financial sector. And of course, you know from what I said before, that that financial sector, the 40% share of total profits in the US, I think is correct. But that was earned by this very risky policy of high leverage. Let me backtrack a little bit. The dynamics of high leverage that I talked about before, which where competition in banking leads the banks into more and more risky assets and higher leverage, is one where they cause serious systemic risk to accumulate. So this is something that we would have a social interest in curbing. Part of this instability of the leverage accumulation process and then the collapse of it is that the high rates of return also attract a lot of human capital that would be better employed elsewhere. And it would be a blessing for the United States if some people graduating from Harvard with high grades and so on would avoid Wall Street and go and try to fix the automobile industry or something like that. So we are dealing with a system where part of it's unstable, and the instability can bring the whole system down, and it's causing resources to be invested in the wrong direction. It's generally true, I should say. This goes beyond your comment. That when the system is unstable, lots of economic verities are turned on their head. And that's particularly true when it comes to economic policy, as we see in this collapse, that when the collapse happens, prudent macroeconomic policies make things worse. And you have to do, and it basically takes what are normally reckless policies to stop the collapse. And I think we have to think in these terms also when we consider what would be the appropriate role of the financial sector over longer terms, that as long as it's unstable, laissez-faire policies are not the appropriate ones. I'm not sure I gave an adequate answer.
Is based on leverage, lucido leverage elevato non solo per le banche. High leverage not only for the bank, that point there. You pointed out that from the 70s up to now, leverage was higher, not only in the banks, but also among households and governments. So general increase in debt income all over. Actually, what I wonder is that has a relation with the fact that at the global level, that is the world level, you notice an increase, a huge increase in macroeconomic imbalance, and macroeconomic imbalance, that is to say that there are economic areas having a higher and higher debt and economic areas having higher and higher asset to be invested in the United States. So there are two things happening at the same time. Has a causal relation between these two things. The second question is related to the bank and the financial sector. You talk the financial sector as if it would be an homogeneous sector, roughly homogeneous, that is to say a sector having the characteristic of the American sector. Actually, in the financial banking sector, there are two quite different animals. A commercial banking sector and, let us call it, an American sector, financial sector, in which business is mainly get from the difference between assets and liabilities in terms of financial asset and financial liabilities. Whereas the first one, obviously there is also asset and liabilities, but they are different nature. Lending and receiving money from families and borrowing and lending to enterprises. The difference of these two sectors is that the financial one has a very high profit, the other one much lower profit. The first one is much more risky, the second one is less risky or a different kind of risk. I think that the instability is given by the first, but the second has the problem of survival, because if two sectors earns different profit, economic theory suggested us that sooner or later the most profitable one will overcome the other one and will disappear, unless there is a different something which, how to say, makes possible the coexistence of these two sectors in terms of different ownership, some different rules about ownership or something else. How is it? And also what you say at the end of your lecture about the incentives is very much appropriate for the first one and perhaps less appropriate for the second one. How you can cope with the problem of having two different animals in the same cage?
Okay, the first question was, do the global imbalances have a causal role in the buildup of leverage? And I think the simple answer is yes. I don't think it's a matter of a single factor explanation, but certainly the huge inflow of capital in the U.S. to finance its trade deficit changed the nature of American banking. The other one, I had talked as if we had a homogeneous financial sector, and you brought back the distinction between commercial banking and investment banking. You know that the Volcker proposals now before Congress, Paul Volcker, his basic instinct is we must bring back the distinction between commercial and investment banking, and we must build a wall between them. I've been trying to think about this problem, and I guess I think maybe it cannot be done. And the reason is the one that you already alluded to, namely the deregulation in the United States was partly, it's true, it was reckless the way it was done. But it was not altogether unmotivated either. The commercial banks had basically been losing out. They were shrinking. They were not earning the rate of return of other financial institutions. They were losing the deposits to the money market funds, which was their basic way of financing themselves. This loss of deposits was in large part due to the fact that the banks were under reserve requirements that made the deposits costly to them in a way that did not apply to the money market funds. And as a consequence, we basically abolished reserve requirements. That was a big part of the dismantling of the Glass-Steagall Act and so on. So the competition from other sectors were in the early 90s, people wrote papers with titles like, "Will the commercial banks survive?" Right? And the way they were enabled to survive was to allow them to do all the investment bank functions and then some. Now, a fundamental problem of the system that we have allowed to develop has to do with what we call network connectivity. And it's easiest to talk about it in relation to the old American system, the Glass-Steagall system. Glass-Steagall, I used to say in class, was built on the notion of a big ocean liner with many watertight compartments. So each type of financial institution had its own compartment, which dictated what liabilities it could issue, what assets it could invest in, and it couldn't go into the next department, which had another liability, another class of assets, and so on. And the notion was that this made for an unsinkable ship. Well, in the 70s and then in the 80s, we had the big crash of the savings and loan institutions in the United States. That was at about that time a very big industry. And the interesting thing about it was that was the mortgage industry in the United States. That's where you got your mortgages altogether. You didn't get them from commercial banks. You certainly didn't get them from investment banks. You got them from savings and loan institutions. So in the late 70s, early 80s, we had a big crash in the American mortgage markets, which took eventually took down this industry. It disappeared with considerable cost to the federal government. The point about it is, a subprime mortgage, a mortgage crisis had occurred before with big losses for those banks, but it did not spread to the rest of the American financial system, and it did not spread. It didn't spread to the whole world. All right. Why? Because it was confined within these watertight compartments. So economists have some blame to carry for not understanding one of the consequences of deregulation, which was that when all kinds of financial institutions can be in all kinds of markets at the same time, the nature of the network that connects all these institutions changes. So back in the 70s, we could have failures in mortgage financing, in the savings and loan, but it didn't affect the commercial banks. It didn't affect the investment banks. It didn't affect well, we didn't have hedge funds at that time, and so on. But today, we have a system that is so interconnected that a failure in one part of it is transmitted throughout. And one reason why Volcker belongs back to the old days, he says, if we could just divide them down the middle, and the line would go between commercial banks and investment banks, we would make it much safer. It's not clear that it's feasible. And the reason is, if you recreate all commercial banks, they won't earn the rate of return of other financial institutions, and all the talent will go elsewhere, and that industry will shrink, and it won't be able to do what we want the commercial banks to do. That's one reason why I argue for this double liability as a possibility.
Bene, molte grazie. È tardi.
Thank you very much. It's very late. I understand that we don't have time for many other questions. I'd like to thank Axel, who, by the way, has been named Professor Emeritus of the Trento University. And I believe that you now know why. Thank you very much to Axel.